In the gold trade, I don't think, well, we probably are in the early stages of a bull market, but I would point out to you that an awful lot of the gold buying has been central bank buying. I would ask you to look at your own gold brokerage business in terms of retail participation. While it is true that for the last 20 weeks, there has been net retail buying, at least as evidenced through the ETFs. That retail buying is tepid. The move that we've seen in the gold price, while welcome to the gold adherents, is not anything like the move that we saw in the gold price in 1971 or 1976, or in 2002, 2003, or in 2009. And it takes that type of buying. It takes a dramatic move in the gold price, and it takes a growing recognition of the precious metals narrative among generalist investors, not you and I, to move the silver price. And we haven't seen that yet. Can see the future. Only hindsight's 2020. I've joked with you before, Dunnigan, that bearishness hasn't paid for me. Doug Casey and I joke that we've accurately foreseen 17 of the last 3 recessions. And so I try to stay partly in the market, but I also maintain a fair bit of liquidity, in effect attempting to have my cake and eat it too. We've talked before too, Dunnigan, about the fact that having cash necessarily means negating purchasing power. If you're receiving 4.5% or 5% on your savings, and the purchasing power of your savings is declining at 7.5% compounded, it means that your purchasing power is declining by 2.5% a year, which is unpleasant. But if you believe that there is a reasonable chance of a decent decline and an outside chance of a liquidity event like 2008, then I think that you have to be reasonably liquid, which I am. Now, I need to say that in my life, I've made money on the micro, not on the macro. I've made money by studying individual companies in greater depth than other people have, and deciding sometimes that almost irrespective of the big picture outcome, that something is cheap enough, or at least that the juxtaposition of risk to reward is attractive. So while I believe that Biden is a risk, Biden's not a risk anymore. He's on the beach where he can do no harm, which is great. If you believe that Ms. Harris is a risk, and if you believe that Trump is a risk, I would point out to you that both are true, but your greatest risk is you. Your greatest risk is not controlling your emotions, not doing enough work. Don't let Trump or Harris be an excuse to fail. Remember that it's your money and the buck stops with you. I need to say that I am concerned in the intermediate term that so many of the idiotic policies of both candidates attract anything but widespread skepticism and scorn among the electorate. But I'm not going to let that intermediate term concern keep me from making money. I was going to say that I would try to make money despite them. That's wrong. I'm going to try to make money to spite them. Among other reasons. I suspect that should Ms. Harris be elected, that the market will perform less well in the near term than should Mr. Trump be elected. The reason for that is that most investors are or seek to become rich people. And Ms. Harris is running on a determinedly populist theft agenda. The idea of taxing unrealized capital gains is a completely preposterous idea. But the fact that it's attracted so much positive attention is a little scary in the long term. It makes a professional investor like myself feel sort of like I'm walking down the street with a bullseye painted on my back. I don't expect her to get away with it. You know, those Wall Street backers of hers who have always prevented, as an example, the carried interest exemption from getting taken away, probably have a little visit with her, slap her around a bit after the election. What bothers me isn't so much the proposition as its popularity outside the Beltway, and that is scary.
Expanding on Rick Rule's observations and adding depth to the broader discussion on gold, silver, and investment strategies in the current economic climate provides a rich opportunity to further explore the forces driving these markets and the psychological and structural challenges facing investors. As we delve deeper, it becomes even clearer why understanding these elements is critical to long-term wealth preservation and growth, especially in uncertain times. Rick Rule emphasizes the need to be patient and disciplined when investing in precious metals. Timing the market is notoriously difficult, and waiting for the perfect moment can often lead to missed opportunities. As Rule humorously states, he and Doug Casey have predicted 17 of the last 3 recessions, underscoring how frequently analysts expect downturns that don't materialize in the anticipated timeframes. This sentiment reflects the broader reality of investing. The market rarely behaves exactly as we expect it to. What investors need to focus on, Rule suggests, is being in the right position over the long term, especially when it comes to gold and silver. These precious metals have historically performed well during times of economic uncertainty, inflation, and currency devaluation. Waiting for the perfect entry point often results in missing the boat entirely. Investors who are overly cautious, always anticipating the next dip or correction, often miss out on significant gains when the market eventually moves in their favor. Rule also highlights the necessity of keeping a level head and managing emotions. It's easy to get caught up in the excitement of a bull market or the panic of a downturn. However, the best investors, those who achieve long-term success, are the ones who remain rational and make decisions based on sound analysis rather than emotion. Liquidity is another topic that Rick Rule emphasizes. He explains that while having cash means you might lose purchasing power due to inflation, maintaining liquidity gives you flexibility. This is crucial because in moments of crisis, like the 2008 financial meltdown, having liquidity means you can take advantage of opportunities when assets go on sale. In a world where inflation erodes the value of fiat currencies, precious metals like gold and silver become safe havens for wealth preservation. This isn't about timing the market perfectly, but rather ensuring you have enough liquidity to seize opportunities when the market presents them. It's a delicate balance of being in the market while also having the liquidity to act quickly when needed. Rule's comments about the political landscape are also worth noting. He doesn't shy away from discussing the potential risks posed by both Harris and Trump, but he quickly points out that the biggest risk is letting these political factors cloud your judgment. Whether it's the threat of populist policies or tax changes, investors need to focus on what they can control, their own decisions. The idea that Harris might introduce a wealth tax on unrealized gains is certainly concerning, but as Rule notes, professional investors know how to navigate these challenges. In the long run, it's more important to focus on the fundamentals of your investments than on the day-to-day noise of politics. The question remains, why gold and silver? Why not other commodities or assets? The answer lies in their historical role as stores of value. Precious metals have been used as currency for thousands of years, and their value has withstood the test of time. As Rule notes, we are likely in the early stages of another precious metals bull market, driven by economic uncertainty, inflation, and geopolitical tensions. Gold and silver are not just safe haven assets, they are also critical to industrial applications. Silver, in particular, is used in everything from electronics to solar panels. As demand for green technology grows, so too does the demand for silver. This creates a unique dynamic where silver is both a precious metal and an industrial commodity, making it an attractive investment in a world increasingly focused on sustainability.
In my experience, we need a real precious metals bull market in order for silver to break out. And in the gold trade, I don't think, well, we probably are in the early stages of a bull market. But I would point out to you that an awful lot of the gold buying has been central bank buying. I would ask you to look at your own gold brokerage business in terms of retail participation. While it is true that for the last 20 weeks, there has been net retail buying, at least as evidenced through the ETFs. That retail buying is tepid. The move that we've seen in the gold price, while welcome to the gold adherents, is not anything like the move that we saw in the gold price in 1971 or 1976, or in 2002, 2003, or in 2009. And it takes that type of buying. It takes a dramatic move in the gold price, and it takes a growing recognition of the precious metals narrative among generalist investors, not you and I, to move the silver price. And we haven't seen that yet. What we have seen is dramatic moves in some silver equities that have performed as companies. Look at Silver Crest after the disappointment around the reserves valuation, when they reached nameplate capacity and started generating cash. Stock's been on a tear. Mag Silver Stock's been on a tear. The thing that I want to point out to your listeners is that the market cap of reasonable quality silver companies is so small that, first of all, when the generalist investor decides to crowd into them, there isn't enough room in the market caps to contain it. And secondly, there's a coterie of professional investors, myself included, who is willing to buy the high-quality silver stocks in anticipation of the money coming into it, in the same fashion that there was a group of us willing to buy uranium stocks in 2021, understanding what would happen in the face of the uranium price increase. There's a group of us that are, I wouldn't say we're happy, but we're conditioned to being a year and a half or 2 years early. And what you're seeing in those high-quality silver stocks is absolutely pro-positioning. Are we going to be early? Probably. Are we going to be wrong? Maybe, but it's a really interesting print if you think about putting together a portfolio of those companies where if you're wrong, you lose 30, 35, maybe 40%. And if you're right, you make 500% or 600% or 1,000%. It's precisely that juxtaposition of risk to reward that your listeners need to familiarize themselves with. And while they all want the upside, they need to ask themselves if they can stand the volatility, if they can stand the time it takes to be involved in the trade. And most importantly, if they're willing to do the work to segregate in movie terms the good from the bad, from the truly ugly, because there's lots in that latter category.
The core reason to invest in gold and silver remains their historical role as a hedge against inflation and currency devaluation. In times of financial crisis, governments often resort to printing more money to fund deficits, which leads to a devaluation of fiat currencies. This is exactly what we are seeing now as governments worldwide have engaged in unprecedented levels of monetary stimulus to combat the economic fallout from the COVID-19 pandemic and other geopolitical tensions. This devaluation has a direct impact on purchasing power. As Rick Rule notes, if you're earning a 4 to 5% return on your cash savings, but inflation is running at 7% or higher, you're effectively losing purchasing power every year. In this scenario, even a safe investment in cash or bonds becomes a guaranteed loss in real terms. This is where gold and silver come into play. They have intrinsic value that is held up for thousands of years, making them reliable stores of value when fiat currencies falter. A key point Rule makes is that many investors are not yet awake to the necessity of owning precious metals. Retail buying of gold, while on the rise, remains tepid. This suggests that we are still in the early stages of the next precious metals bull market, with plenty of room for growth as more investors recognize the need to protect their wealth. While gold is often seen as the ultimate safe haven asset, silver has unique characteristics that make it an attractive investment as well, particularly in the current economic environment. Silver, unlike gold, has significant industrial uses. It's used in electronics, solar panels, medical equipment, and increasingly in renewable energy technologies. The growth in demand for these applications, especially as governments and corporations push towards green energy solutions, is expected to drive up the demand for silver dramatically. Rick Rule points out that silver is currently trading at a ratio to gold that is far above its historical average. Historically, the gold-to-silver ratio has been around 16 to 1, meaning that 1 ounce of gold would buy 16 ounces of silver. Today, that ratio is closer to 85 to 1, indicating that silver is significantly undervalued relative to gold. This presents a compelling opportunity for investors, as silver has the potential to outperform gold in percentage terms during a bull market. Additionally, silver's strategic importance cannot be overstated. As Rule notes, silver is essential for the production of high-tech weaponry, renewable energy infrastructure, and even basic technologies like mobile phones and computers. As global demand for these products increases, so too will the demand for silver. Yet despite this rising demand, silver's supply remains constrained, with mining output unable to keep pace. One of the reasons many investors shy away from silver is its notorious volatility. Silver tends to experience more dramatic price swings than gold, which can be unnerving for those not used to such fluctuations. However, as Rule emphasizes, this volatility also creates opportunity. The key is to manage risk appropriately and to be prepared for the inevitable ups and downs. In a well-balanced portfolio, silver can offer significant upside potential. As Rule explains, If you're wrong, you might lose 30 to 40%. But if you're right, you could gain 500 to 1,000%. This asymmetric risk-reward profile is what makes silver so appealing to bold investors who are willing to endure short-term volatility for the chance of long-term gains. Investors need to ask themselves if they are willing to tolerate the volatility that comes with silver investing. If so, the potential rewards can be enormous, particularly if we see a sustained bull market in precious metals. As Rule mentions, those who are positioned early will be the ones to benefit the most when the broader market finally wakes up to the value of gold and silver. The political landscape is another factor that investors must consider. Rule doesn't shy away from discussing the potential risks posed by various political figures and policies. He mentions that populist policies, such as those proposed by some U.S. politicians, could have a detrimental impact on the market. For example, the idea of taxing unrealized capital gains is, as Rule puts it, completely preposterous. But the fact that it has gained traction is concerning. However, Rule is quick to remind investors that political risks are just one part of the equation. While it's essential to stay informed about potential policy changes, it's even more important not to let these risks paralyze you into inaction. As he says, the greatest risk is not Harris or Trump. It's your own inability to manage your emotions and make rational investment decisions. The underlying message in Rule's analysis is clear. The world is changing, and investors need to adapt. Whether it's the devaluation of fiat currencies, the rising demand for silver in industrial applications, or the political uncertainties that lie ahead, those who position themselves in assets like gold and silver stand to benefit. But, as Rule emphasizes, this isn't about jumping on a bandwagon or making rash decisions. It's about doing the work, understanding the fundamentals, and having the patience to let your investments play out over time. Gold and silver have been stores of value for thousands of years, and they will continue to be so. The key is to act before the rest of the market catches on. For our viewers, this means thinking long-term. Yes, there will be volatility, and yes, the political landscape may shift. But gold and silver offer a hedge against these uncertainties. Those who have the discipline to invest in these assets today will be the ones who reap the rewards tomorrow. Rick Rule's insights underscore the importance of being prepared and positioned properly in today's market. Whether it's managing liquidity, navigating political risks, or capitalizing on the opportunities in gold and silver, the message is clear. There are significant opportunities for those willing to do the work and stay patient. As the world continues to grapple with inflation, currency devaluation, and economic uncertainty, gold and silver will remain crucial components of a well-diversified portfolio. The time to act is now, before the broader market catches on. Don't wait for the media or the public to wake up to the value of these precious metals. Position yourself early, stay disciplined, and you'll be well ahead of the curve when the next bull market takes off.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.